Hello, and welcome to episode 20 of Bitlemmas. I'm Watson. I'm here with B. Sovereign. And today is a book review of A History of Money and Banking in the United States by Murray Rothbard. Central banking is not neutral plumbing. It is a legal architecture for coordinated inflation and cartelized credit. You can treat this book as a counter history of U.S. money. Rothbard is not only asking what happened, he's asking who benefited from each institutional change. Who gained legal tender privilege? Who could suspend redemption? Who got elastic reserves? Who received new credit first? Who supplied the expert story? And who lost the ability to exit? The standard story says money shortages justify paper money. Panics prove markets need a central bank. The Fed is a disinterested technical fix. Expert reformers simply modernized the backward banking of the global South, and gold discipline is obsolete nostalgia. Rothbard reverses the question: did the reform solve disorder, or did it remove discipline and create privilege? We'll be reviewing 4 counterintuitive truths. Scarcity was often policy made. Central banking is a cartelization by law. Expertise can launder privilege, and managed international money exports inflation. So, what is this book? It's a monetary counter history of the United States, like we said. A theory first reading of coinage. We'll talk about what that is. Banks, panics, and the Fed. It's a motive question. Cui bono? Who benefits from monetary privilege? It's a warning that stabilization language can hide cartelization. And it has a structure. It's 4 essays: colonial till 1789 money, the Fed's origins, the New Deal, and the International Gold Exchange Standard. Now, what's the standard story? Money shortages justify paper money. Panics prove markets need a central bank. The Fed is a disinterested technical fix for these shortages. Expert reformers just modernized the backward banking of the global South and others. And gold discipline is merely obsolete nostalgia. Now, what's the thesis of the book? Monetary history is institutional power history, and you should read it as such. Legal privilege turns bad money into policy. We're going to talk about what bad money is. Central banking coordinates inflation and protects the banking cartel. We'll dig into that. Expert legitimacy can make privilege look like public interest. And we're really going to talk about that on a couple slides. Now, managed international money structures claims as pyramids, or you can say reverse pyramids, until confidence breaks. And that's confidence in the money. What are the major premises of the book? Redeemability disciplines paper promises. What do we mean by redeemability? We're talking about convertibility from a note into the underlying asset, most likely gold. Legal tender can overvalue weak money and drive stronger money out. This is Gresham's law. We'll talk about this. It's quite counterintuitive. Fractional banking without redemption, remember the redemption is the convertibility, fails to discipline the pyramid. We'll talk about the pyramid, the claims of the pyramid. And cartels usually need state coercion to survive competition. And lastly, centralized institutional reserves export inflation across borders. We'll dig into all of these premises as we go forward. Now, our 4 counterintuitive truths again. Scarcity was often policy made. Central banking is cartelization by law. Expertise can launder privilege, and managed international money exports inflation. Truth number one, scarcity was often policy made. So when we're talking about scarcity, there's a story behind it. And when we're talking about it, we're talking specifically about money. So the scarcity story can be backwards. Legal tender paper drives specie out through Gresham's law. What is this? The idea that good money is driven out by the bad money. What does that mean? People, if they have something that they think is more valuable, they won't want to circulate it if they have something that they think is less valuable that other people will take. So if you have really bad money, like paper, people will be very willing to circulate it over something like gold. That's kind of the law. That's kind of the idea behind it. And he uses it in a particular way. So paper depreciates. And when we say paper, there's different ideas behind the paper. We're really, in some senses, saying a claim on the redeemability to something like gold. And then that can depreciate. Why? Because they can print more, and then people can realize that they're getting diluted, for instance. Prices rise because people, when there is a printing of the notes, paper, they want more of it in order to exchange. And exports, so we're talking about nations now, exports are hampered. So people, when there's a money printing, oftentimes what can happen is that the country, let's say Britain or United States, their exports, everything is more expensive. So if somebody wants to buy, especially if, and we could talk about this some more, if they peg the money to a certain amount of gold, it can make things internally more expensive and no one wants to buy it. And then things externally cheaper, depending on the arrangements. But we could talk about that more. Retiring paper and resuming specie being things like metallic money, so gold or silver, and it also can be coinage being a coin. Why does that matter? A recognizable gold or silver, that can restore the trade. And bad money wins by privilege. So here's where Rothbard is saying that it's a mandate from the state on why, in this case, the bad money is winning. And it's not winning by market superiority because, it's like gold versus silver or something like that. And where people want the gold more than silver or something.
The deeper insight here is that the fix and the problem are the exact same machine. When a system says it solves scarcity, ask whether its rules are actually driving better money, collateral, or liquidity out. Bad money wins because law privileges it, not because users freely prefer it on a competitive market. So for builders, the diagnostic question is, does your token system that you're using create scarcity by driving out the very collateral or liquidity it claims to solve?
All right, so here we have the diagram. This scarcity complaint on the top here is something that Rothbard says is a myth. Rothbard actually believes that money can't become scarce, that prices will just adjust to whatever amount of money you have. And he uses examples of gold coins. He would say, outside of the United States and other countries, that the prices, again, they would just adjust. But since there's a complaint, there's not enough, then that legitimizes legal tender paper issue. And we're going to talk about this some more, this concept of creating paper and it having the ability to issue notes in order to solve crisis. But legal paper issue happens when people say there isn't enough money in circulation. After that happens, then you have specie. Again, remember, specie is metallic money or coinage, so gold or coins, leaves circulation. This is the Gresham's law. So that would be the superior money. And then you have the bad money. And then you have depreciation of the paper and rising prices because people want more of the money for the exact same asset. And so this is where he's saying, because there's a scarcity complaint, and then there's a paper issue based off of that paper issue being created by the state. This is a policy-made shortage. Why? When there's depreciation, you need to print more. There's a shortage. And so you need more in order to buy, then they need to print. And so that's where he's saying that this is a policy-made shortage. Central banking is cartelization by law. Bank credit inflation benefits lenders and first recipients. This is also the Cantillon effect, or known as the Cantillon effect. The people closest to the money printer benefit the most. National banking centralizes reserves, so the things that are the money is supposed to be backed by, the notes are supposed to be backed by, but still left the instability. We're talking about 1906 or 1907, when in the United States, when there was a money crisis, that this was the impetus for creating, or the beginning of the Fed Act. And then the author Rothbard is saying, even after you had the Fed, there was still instability anyways. And you have big banks wanted elastic reserves and lender of last resort support. Elastic reserves, we're going to talk about some more in a later slide, but it's a nice euphemism. But the nice way to put it is having the ability to print to stretch the money supply to handle a crisis. And the lender of last resort is a nice way to say that the bank is going to have some type of insurance so people don't do a run on the banks. We're going to talk about both of those as euphemisms. The Fed made banks joint owners of a central dominating powers. What do we mean there? The Fed is a group of the biggest banks in the United States, and they all own the ability to, and they have a privileged relationship with the Treasury, and they can print and all this stuff. The result is a coordinated inflation with weaker redemption discipline. What do we mean? Again, the redemption is if someone comes to the bank and says, I have a note that you issued to me, I want the gold, that I want to redeem it. I want you to convert this to gold. That creates discipline. So they don't have enough gold, then they can be punished. They maybe even can go to jail. But since you have this coordinated inflation, then you don't have this market discipline that Rothbard talks about.
So, yeah, the cartelization chain is the mechanism that they ultimately use here. Credit inflation beneficiaries seek elastic reserves. They mobilize support after a panic. And the example here would be the Panic of 1907, which consolidated banker and business support. They centralized power through the Fed Act, and they created a sanctioned banking cartel. The lender of last resort is also the coordination hub in this instance. So for builders, the key insight is that an institution can be technically useful to a privileged coalition, and that usefulness explains why the coalition builds and defends it. The claim is institutional and incentive-based, not a claim that every central banker is personally corrupt.
So we just went over this, but you have the credit inflation beneficiaries. Who's that? The people closest to the money printer. So that's people who can get cheap loans. And then, of course, the actual central banks when they're printing. Then there's this idea of the elastic currency campaign. What is this? So the idea that you, in order to handle a crisis, you need to have the ability to print and control the money supply. The panic creates the support for the elastic currency, or reinforces that. So people saying there's not enough money in supply, that someone can answer, an expert can answer and say, oh, that's why we need the ability to print. So all of those together creates the impetus for the Fed Act, creating a central bank. And then you have the centralization of power. Again, the power is the money printing. And who is it that is able to get the money? And the Cantillon effect It's who can get the money before the inflation, the effects of inflation hit or land. And after that, you have a sanctioned banking cartel. You have a group of banks that are able to operate in the Cantillon effect, and then those very close to that. And Rothbard is very specific on calling out these different groups that are very close. Now, truth number 3, expertise can launder privilege. Rothbard says motive blind history misses the institution. So he's critiquing how we view history specifically for money. For other kinds of history, we are very sensitive to motive, especially things like war history. But for some reason, on monetary history, we don't ask cui bono, which is who benefits. Cartelization needs public consent. So that's a problem. If you want to have people controlling the money printer, the people need to buy in for that group. Intellectual supply, a public interest story. I'm going to give an example of this in a bit. Regulatory commissions can cartelize in the name of fighting the monopoly, and technocratic reform can hide who benefits. So what do we mean here? Here's an expertise argument. If a politician says, we're going to pass a law that allows Wall Street banks to dilute your savings so they can bail themselves out of bad investments, the public would riot. But instead, if you have technocrats or experts who reframe the exact same action, but using dense and clinical jargon, they can do it like so. They could say, we're going to be implementing a macro prudential monetary policy to optimize system liquidity via open market asset purchases. In that sense, now you have the laundering of the privilege.
And this brings us to the legitimation chain. It is a cartel problem becomes a public consent problem. Experts frame the reform, commissions standardize the rules, and privilege looks like public interest. A technical story hides a beneficiary story. So for builders, the lesson is that a clean interface or expert vocabulary can hide a power transfer unless the beneficiary and control surface are visible. So ask who supplies the expert story. That makes the control surface look neutral. That question works for monetary history, and it also works for protocol design.
So the diagram here, we've got the cartel problem. Like we said, you have the public consent is needed in order to have a cartel, the cartel problem being those who want to make the cartel. The experts frame the reform. The commissions standardize the rules. This is the cat watching the canary, and regulators being involved and invested, incentivized for the people they're supposed to be regulating. And then privilege looks exactly like public interest, like we were saying. Now, truth number 4, managed international money exports inflation. We pretty much reviewed this concept in our last book, The Hidden Repression. The classical gold disciplines central bank inflation through outflows. So central banks can't do whatever they want if people expect a redeemability or convertibility of their notes. Gold exchange systems replace gold with dollar reserve pyramids. What is this? A global South bank can, first they have their deposits in their banks, and then they have and that's their part of their, what they base their fractional reserve on. But then they have their central banks. And what are their deposits? Well, let's say it's a global South, what Rothbard says the experts are saying are backwards. They're still using gold. But the smart experts come in and say, you should hold the reserves as dollars or pounds. instead of gold. So now they replace their gold with dollars, paper dollars in their reserve. And now they are dependent on in this case, United States or Britain, and they're part of a pyramid. What are some problems there? Overvalued parities require other countries to inflate as well. For instance, Britain pegging their pound to gold too high. They believe it was 1930s. They were pegging it to 4.87 pound to an ounce of gold, which is worth now $4,000. That created a chain reaction, but it also, if everybody, is now part of this pyramid, when they inflate, everyone else has to inflate with this parity. So the U.S. and Britain exported policy, their domestic monetary policy, through this whole reserve architecture. You all need to hold dollars. The pyramid, of course, is going to break when people want to hold gold instead of the dollar.
And that goes to, this is how the pyramid ultimately breaks. When confidence shifts back toward gold, when reserve claims outrun credible gold redemption, and hard money partners resist subsidizing the system, reserve pyramids move inflation across those borders until confidence breaks. So for builders, the question is, what happens when confidence runs backward toward hard settlement? If your system depends on a reserve architecture that can be inflated, what breaks first?
So you have gold discipline removed, redeemability is removed. The sterling dollar reserves being held again in I'll say a foreign country, or let's say the global south. So that's a client currency. And now you have claims that are not in the foreign country, on this client country, not on gold, but claims on redeeming a dollar, for instance, a paper note. Then, of course, the parent country could also get off the gold standard. And now everybody has to play a game with this inflation. So previously, an individual country, global south country, if they decided to inflate, they would receive market discipline. But if all the central banks all get together, they all want to inflate at the same time. And then, so at some point, Rothbard says the confidence would break and people would go back to something like a gold. They would have a problem with all of these notes and claims in the pyramid. So what does managed money look like? In the 1920s, the Fed supports props, Britain's overvalued pound. 1929, credit boom turns into a crash. 1930s, monetary nationalism replaces stabilization. And in 1940s, Woods makes the dollar the key currency. And 1960s, the dollar claims outrun available gold. What's the hard version of what Rothbard is saying? Don't read this book as nostalgia for old coins. Read it as a theory of monetary control. Cui bono, who benefits? This is what he wants to inject into this historical critique. The question is, who got a legal privilege and who lost an exit? If motives are hidden, public interest stories can protect extraction. And we're going to get into this in this argument. So what is it that I'm thinking that this is the central argument of this book? Central banking is inflation coordination. Now, if elastic reserves is a euphemism for a bailout for big banks, then big banks will use the term elastic reserves instead of a bailout for big banks. If elastic reserves, also known as bank credit inflation, benefits lenders and first recipients, remember Cantillon effect, then those beneficiaries will seek elastic reserves. If national banking is unstable and not fully centralized, then big banks will push for a lender of last resort, also known as a bailout for the banks, that is centralized, that they can make into a monopoly. If experts and elite commissions validate a reform, such as a centralized elastic reserve, then that reform, such as the Fed Act, will have reduced blowback. If they validate it, it'll have reduced blowback as experts. So finally, if by using euphemisms and reducing blowback, experts and elites protect coordinated inflation, then a coordinated inflation, such as central banking, is illegitimate. Now, where Rothbard is contested, the monetarists, like what we reviewed, counterintuitively on the right, Friedman and Schwartz, they said the Fed caused the 1929 to 33 collapse by letting the money supply fall. They had the power and they didn't do anything. And so that's why there was a crash or collapse. This is the reverse of Rothbard's intervention, prolonged the problem. The Keynesians, on the other side, are saying the Depression was a demand collapse. Remember, supply creates their own demand. You go back and watch that. Not healthy liquidation blocked by meddling. And then you have the free bankers who say fractional reserve banking can be totally stable. It's not inherently fraudulent. So where the Fed was created at the Jekyll Island, it is a historical fact that it was created there. But financial blocks, secretly run policy is a strongly contested reading in the economic monetary literature. Now, onto our critique of the book. So we have craftsmanship. In our craftsmanship critique, we are going to be reviewing monetary power, or a language for monetary power. We have our 3 ways of critiquing a language. We want to build a language and solve a problem inside the language. When we do that, you have primitives to critique the language, any language, especially programming languages. You have the primitives, you have the fundamental methods of composition, and you have the fundamental methods of abstraction. So within the monetary power and policy language of Rothbard, you have the primitives of specie, notes, deposits, reserves, legal tender, and redemption. These are the things that you can compose. And you have your fundamental methods of composition. Reserve pyramids, we talked about earlier. Note monopoly, so sanctioned banks that can print. Suspension, so what is suspension? Saying that we are no longer going to redeem or convert the notes into gold. And the lender of last resort, this idea of you don't want to come in and try to redeem because you're protected, or we're trying to disincentivize you to do that. Now, abstractions, fundamental methods of abstractions, these are the workhorses, and they're kind of ways to reason about the main problems within the domain. Bad money privilege, we talked about that. The idea of bad money drums out the good, and the ability for someone to print is a privilege. Sanctioned cartel, we talked about that as well. The idea that you really need to have the law in order to make a central banking system. Otherwise, people would reject it. Expert cover. So this is the experts reducing blowback on concepts. And then the dollar pyramid. So this is the client privilege of foreign countries. I'm sorry, client privilege, but the client banking, where they no longer in reserves have gold, they hold a dollar, and then they get this whole problem of exporting the inflation. So if you're going to talk about all of this stuff, you don't want to talk past each other. One of the things within this domain, in order to avoid talking past each other, you want to name the privilege, the money privilege, the bad money privilege, before even debating anything in this domain, or you're just going to talk past each other.
All right. So now we have the exit and choke point analysis from Rothbard's framing. So to start off, for choke points, we have legal tender, note monopolies, reserve hubs, the gold window, and bank holidays, right? These are all monetary choke points from his framing. Legal tender decides what counts as money. Note monopolies decide who can issue. The reserve hub controls elasticity, and the gold window controls redemption. The bank holiday suspends everything. So, exit paths to Rothbard's framing are specie redemption, foreign coins, contract gold clauses, and self custody. So, common exit paths across US history, which I mean, we did hold specie, which were the metallics that we talked about earlier, using foreign coins, which, if we were to deal with other currencies and that nature, writing gold clauses into contracts and self custody. Each of these was closed at different points or were closed at different points. Gold clauses were banned in 1933 and they weren't restored until 1977. So, the control surface is who can suspend payment or change redemption terms. This is the core question. Who has the power to suspend? This is a recurring theme across all of the books that we have reviewed, is who can change redemption terms overnight, and that power is ultimately the choke point. It's in the protocol itself. So for the Bitcoin adjacent question is, can users verify supply and settle without permission? The answer here is yes, but and this is our framing. This is not necessarily Rothbard's. Rothbard predates Bitcoin and never makes this claim, but the question follows directly from his analysis is, can users verify supply and settle without permission from the monetary issuer or the banking cartel? And our trade-offs. Discipline is painful and discretion is capturable. When we say that discipline is painful, gold outflows, they do force contractions, right? And those panics force liquidation. But discretion is capturable. Whoever controls the elastic reserves, as we stated earlier with money printing, can coordinate inflation and block an exit. So that is the trade-off.
Now, we also want to talk about if we're building a system for people that, let's say, for instance, we're trying to build a system that is going to have some type of value locked into the system, and you're going to have to do some type of, hopefully not issuing, but management of the issuing and these types of things. You want to show the supply rules, the redemption terms, the reserve claims, and the suspension powers. You want to have all of that at the outset in order to have the best user adoption, let's say. The default views should expose who can freeze, inflate, rehypothecate, which is basically a fancy word for relending, and censoring. Again, we have all of these problems within this domain that the author is talking about. And if you're going to try to reason about creating a system or framework within this domain, you would need to, one of the things you want to do is be able to expose all those things from the beginning, make it easy to use the system, make the exit paths visible before the stress arrives. This is a common theme throughout building systems that have value in them, valuable resources. If people are going to leave, or they have the capability of leaving and they want to leave with their value, how easy is it from the outset? Can they see that? And you want to put custody, settlement, finality, and rule change authority in the happy path. Make it easy for when people are adopting your system, the thing you're building. You want to make all of that easy to manage. Some questions to contemplate. Where does your system rely on legal or platform privilege? Who benefits first? When new credit, tokens, or balances are created, so this is the Cantillon effect, can users redeem or exit, or can that right be suspended? Who supplies the expert story that makes the control surface, where all the claims are, look neutral? And what happens when confidence runs back towards hard settlement? So the claims are gone, the IOUs are gone, and people want to exchange at the base money layer. Conclusion, Rothbard reads money as institutional power. Bad money often needs legal privilege in order to exist. Central banking coordinates inflation by weakening exit discipline, and expert stories can hide beneficiary politics. The builder question is, can users see and exercise the exit? So if you're going to take one, this Rothbard reads monetary history as a sequence of institutional control surfaces. Bad money needs legal privilege. Central banking coordinates inflation by weakening exit discipline. And expert stories can hide beneficiary politics, like what we're saying. If you have any comments, leave them in the comment section and visit bitlemmas.com for past episodes and other information. And we will see you